Indian markets have been through the first round of profit booking since the Narendra Modi government was voted back to power. Well, small way, but yes, Indians have booked out more than foreign investors, at least to mutual funds, who are perhaps expecting Modi to act faster this time around. But will the confidence persist if fundamentals don't improve fast? Let's ask the Asia Pacific equity strategist at BNP Paribas Manishi Raychaudhuri joins us right now in our studios. Manishi, so good having you. Great talking to you from Hong Kong. Better talking to you from Mumbai, our studios. What's two-part question? One, right. What has been the central query that all your global investors are asking you? And what's that one big message that you're giving them at a time when the world is a bit uncertain and Indian valuations are stretched?
I see. I think if I were to sort of crystallize this into two most important questions at this point of time, the first would be, okay, the new government is now, in saddle. What are the main priorities? What are the kind of policy measures that we can expect? I mean, everyone knows that there's going to be a bit of a policy continuity from the previous government, but what are the exact measures that one should expect logically? That's number one. Second, despite the new government has now come in with a larger mandate, but the economic hurdles are still very much around, and the government has its job cut out for itself. So how do we think some of these hurdles could be overcome? And are there initial or nascent signs that we are seeing in that process?
Okay.
Now the answer.
Now the answer. That's the big one.
Right. So, first of all, if you consider, one of the biggest problems that India had been facing over past few years, it was the problem of investments. Consumption had been stable. Think of that economist identity, C plus I plus G plus X minus M. It's really that I bit that was missing. We think that there's a natural process by which I could revive, maybe not right now, but maybe 2 or 3 quarters down the line, for two reasons. Number one, we have seen capacity utilizations improve. If you go by macro indicators like the RBI's Obicus survey, they're possibly around 76 to 78% right now. We all know that when it reaches 80% or so, those plans tend to come back on the drawing board. Second, cost of capital is coming down. It's been a slow process. RBI has cut rates twice. Possibly they will cut once or twice more during the second half of this year. But it is not yet translated into actual lending rates. Yeah. And we know partly the reason for that. There's still liquidity deficit in the interbank lending system. We're hopeful that the RBI, after the most recent OMO that they have announced, they will possibly do more to correct that situation. There are, in other words, quite a few levers, quite a few handles that the RBI can pull, and to make it a little more amenable for banks to actually translate that to lower lending rates. And the importance of this...
We keep saying that, but we don't see it happening. And the transmission process seems to be the big
hurdle. One of the reasons is this whole change in stance on the part of RBI. That's also relatively new, right? It started in February. Just about 3 months ago. February, then April, that's when the 2 rate cuts came through. So it's a relatively new process, this whole change in stance from a neutralish to a more benign. So I think we have to kind of hold our breaths and wait for maybe a quarter or two to wait for that to happen. This is important because as cost of capital gradually declines, and there's much more room to cut rates because India has one of the highest real rates right now, especially among the countries which are rated similarly in terms of credit rating. We think that the difference between return on capital and cost of capital, which is the determining factor for corporates to decide on investment projects, that is likely to become much more benign, it's likely to expand more, which would enthuse companies to put in projects going forward. It may not happen right now. It'll possibly happen later this year or early next year. But I think the groundwork is being created.
So from an equity standpoint, how are you analyzing all of this information that you have and the expectations from the government to make suitable choices within sectors and say, okay, now this is what I've gauged, this is what is likely to happen. So this is going to be the key beneficiary, and this is where I'm going to make money.
Right. As far as the government is concerned, think about it again in terms of the structure. What are the factors of production that that are amenable, that are necessary for a manufacturing company to make that decision? Land, labor, and capital. Out of these three, the third, capital, was possibly made a little more available to the manufacturing sector through the structural changes that the government made in the previous avatar through IBC and NCLAT. The other two still remain. The legislative process to make land and labor available in larger quantum to the manufacturing sector, those steps are possibly the first set that the government would have to focus on. We think that it may become a little bit more easy for the government to do that in the present, over the next maybe 1 or 2 years.
Availability of land and labor.
Or rather to make the necessary legal changes and to create the enabling environment compared to what the government faced in 2014. Because not only do they have more seats in the Lok Sabha, they have more seats in the Rajya Sabha.
2020 onwards, yeah.
Absolutely. So the legislative process itself would become a lot simpler, a lot easier going forward.
Okay. Now, so Manishi, the bigger question is, let's assume that all that the bulls are hoping for turns out to be true. If not immediately, then over the course of the next 18 months. Right. How does one make money in such a scenario? Because that one leg, C plus I plus F, C is starting to dwindle a bit.
Right.
Let's assume you leave that out.
Yeah.
How do you play the other two?
Right. Well, the first, leg would possibly be obvious, which is I. We do expect the industrial companies, the construction companies, capital goods manufacturers to do better going forward. The proxy plays are banks and financials which are, engaged in corporate lending. All throughout last 3 years or so, we had been playing India only through the retail lending private sector banks. Now, recently, we have added a few more corporate lending banks as well. So that is, I would expect some of the construction materials like cement also to do well. They've already done well, over the past couple of months or so. I would expect that outperformance to continue over the long term. So that is the first, set of companies that should benefit. At some point of time, I think consumption should also revive. If you think of India, there are close to 300 million families. There are possibly, about 3 million passenger cars that are being sold. That's about 1%. So this situation in an environment of gradually rising affluence can't really sustain. We have a big brother who has shown us the way, and that's China. You think of the Chinese situation about 15 to 20 years ago, that's possibly pretty much where India is, with certain differences. Today, we are seeing more of the sharing economy, coming in, it's more in vogue. So the kind of explosive growth rate that China had seen would possibly not apply to India. But still, even a moderate growth rate from the present levels of low penetration would be stupendous. So I would suggest that one should not ignore the consumer discretionaries as well. That would include autos, that would include household appliances, and so on. But in general, that consumer discretionary space over the long term should also be on investors' radar.
Okay, so let me ask you a counter that.
Right.
How do you play that theme, or which is a better way to play the theme? Would you bet on up trading being the key thing, in which the base to premium would be the key factor? So, branded shirts versus unbranded shirts, premium motorbikes versus the normal motorbikes.
Right.
Is that a better way to play it? Or do you continue betting on staples making a bit of a comeback? And by staples, I would also mean companies which don't have premium bikes, but standard bikes, for example.
Right. Our preference would be for the former. The company, exactly, for that theme of upgrading. Because today in India, premiumization, penetration, digitization. These are the three main drivers that India is benefiting from and likely to benefit from for the foreseeable time horizon. So, companies which are operating in niche segments, they're likely to gain more. Companies which have a wide distribution and therefore have created a massive moat for themselves, they're likely to remain in the driver's saddle. So that's really the main universe that we're looking at as the primary beneficiaries. I would also point out that today, if you look at China or consider where China was about, say, 20 years ago, in the mid-90s, close to 67% of an average Chinese's wallet allocation used to be in the basic necessities, basic food, basic clothing. Today, that proportion is 43%. Where did that remaining 24% go? It went to education, healthcare, discretionary consumption. India is heading exactly in the same direction. India is pretty much where China used to be 15 to 20 years ago. We can't ignore this massive transformation in consumer spending habits.
So in light of that, the auto space slowdown should be just a temporary blip?
I personally think so. So right now, of course, the situation looks dire. We have seen companies cutting down production by about 20-25%. So it may not really revive in the next one quarter. You would see the company earnings come out. Even the first quarter is likely to be quite disappointing. But at some point of time, a foreign investor who has a longer-term time horizon, I think these investments at this present point of time make good sense.
From an FII standpoint, how does India pit against the other emerging markets? And because there is value in China that's coming back in, so why choose India over China?
Right. We upgraded India to an overweight in late March. And right after the election outcome, we increased the weight of India even more. So we have a pretty significant overweight on India right now. If you look at the earnings picture, earnings estimates, they are no doubt drifting down in India, as in much of Asia. But at the same time, the picture looks much less dire in India than in North Asia. If you look at Korea, consensus average EPS estimate is down 35% over past 8 months. China down 20%, even though that seems to be bottoming out. Taiwan down 25%. In comparison, India has declined possibly about 7 to 8%, and it's been a gradual, slow decline. Similar is the picture in some pockets of South Asia like Indonesia. So these are the markets which, from an FII's perspective, are looking relatively less risky than the major pockets of North Asia, which contribute almost 70% of the MSCI Asia ex-Japan index.
There's a chart, Manishi, though, that we put out this morning. Maybe we can bring it up as well. It was the ratio of the Nifty P to the MSCI Asia market price to earnings, and MSCI World P, excuse me. And that's back to 2019 highs. It's not looking very pretty in terms of valuations, even though the EPS cuts haven't, or the earnings cuts haven't been that stark in India.
Yes. No, that is a concern. That is a valid concern. And, I think even India would face certain degree of earnings cuts going forward. When I look at the consensus estimates, it's about 18.2% for 2019, which is the proxy for fiscal 20. For fiscal 21, I see a number close to 21%. It's difficult for these numbers to sustain. I think they would finally settle at around the early to mid-teens, maybe around 14, 15% or so. Having said that, the earnings cuts are not so deep as we have seen in North Asia and are likely to see more. So when you look at these valuations, let's say price earnings, it might appear cheap for North Asia right now. But if that E itself is questionable, then that P might be a completely different number than what we are seeing today.
And that likelihood is lesser in India.
I would think so.
But if we're looking at this consensus earning of 15-odd%, then why should we pay 19 times, 20 times?
See, one of the reasons is that...
I mean, we might, but why would an FII
Why would others pay?
Yeah.
Right. Right. So India always has had one advantage, which is that this is really a more capital efficient market. If you look at return on capital, if you look at return on equity, India, or at least the top 100 companies of India, they would generate something like, higher teens kind of returns. There's a reason behind it. India historically has been a capital-starved economy, and that's why companies are so cautious about spending capital.
Yeah.
So I think this is, it's something ingrained in the management psyche of the large Indian companies. And that is why this capital efficiency tends to lead to that valuation premium. I don't think that's likely to go away anytime soon.
In fact, this was a very similar commentary that came from Mark Mobius as well. He said, "I like the frugality of Indian companies.
Absolutely.
And they're pretty tempered in the kind of big-ticket investments they make. They make those decisions after thinking on it for a lot of time, and it probably shows up in the way they
there is,
reflect
you know,
their
I mean,
ratios.
I wish I could show that chart. I have it in some of my presentations. It is reflected in the indebtedness of countries. If you look at debt to GDP ratio, Asia went from 140% to 210%. What was the biggest culprit? This is right after GFC, from 2008 to about 2018 or so. China went from 150 to 260 to 270%. India has stubbornly remained at about 115 to 120% over last maybe 10 to 15 years. The total debt to GDP ratio, and I'm here commenting on both household debt, government debt, and corporate debt, that hasn't really budged much for India. And this is exactly a reflection of the point that you make just now about frugality of the companies.
Well, maybe we'd love to receive that presentation from you, Manishi, and try and make sense of that as well. But as always, it's a pleasure chatting with you. Thank you so much for taking the time out and being with us today.
Thank you. Thank you very much.
Right, that's an important market view. Manishi Raychaudhuri of BNP Paribas, fairly optimistic what the markets are doing. The Nifty Bank marginally off, but the market's lying flat. It's a wrap on this leg of Indian Open from Devina and me and the team that put this show together. Thanks so much for watching. The FNO show takes forward the action on the other side.